On October 19, 2023, the yield on the U.S. 30-year Treasury inched upward and touched 5%. A small number, a slight bend on a chart that barely changed its shape. Financial news outlets mentioned it only in passing, treating it as a routine fluctuation in the long-term bond market after several months of CPI easing toward 3.2%. For most market watchers, it was not a moment worth remembering. But placed beside other seemingly trivial days in history, October 1979, when the 10-year abruptly broke above 10.4%. Early 1994, when the Fed doubled interest rates in less than 12 months. Or February 2006, when the yield curve began a faint inversion just as mortgage delinquencies climbed 30%. From 2004, those fragments start to form a pattern of their own. No one notices when it begins. Only after the system shifts into its next state do people trace back to find the first crack. The October 2023 event carries that same outline of a quiet marker. Not because the number 5% is special, but because it surfaced at the precise moment when time, in the financial sense, began to change its price. From 2020 to 2021, the United States borrowed at the cheapest levels in modern history, an average of 1.6% on new issuance. By 2023, the same government had to accept coupons above 4.8%. The difference looks modest, yet it pushed federal interest payments to $659 billion, the highest ever recorded. When the cost of the past begins rising faster than the income earned from the future, an economy is forced to repay the time it once borrowed cheaply. Previous cycles show this adjustment never appears on the surface. It moves underneath the domain where yields do the talking. That silence is why bond cycles almost always begin with calm. In 1979, the quiet took the shape of confidence that inflation had peaked even as bond yields rose. In 1994, it came from the belief that growth was too fragile for the Fed to sustain strong tightening. In 2006, it was the trust that the housing market would self-correct. Despite data showing $362 billion of adjustable-rate mortgages scheduled to reset the following year. The details differ, but the logic repeats. When the market believes everything has settled, what exactly is moving in the background? In the 2021 to 2023 cycle, the first answer appeared early. It showed up in the divergence between nominal growth and yields. In 2021, nominal U.S. growth exceeded 10%, a figure rarely seen since the 1970s, while the 10-year Treasury sat near 1.51%. That relationship did not represent reality. It represented expectation. The government borrowed at unrealistically cheap levels while the money supply, M2, expanded by 26% in 2020, creating an environment in which time itself was mispriced. When time is cheap, financial decisions magnify themselves. Households borrow more, corporations issue more debt, governments delay structural adjustments. U.S. public debt climbed above 120% of GDP during this phase. Every cycle hides its seed in numbers like these. A second signal emerged through the movement of capital. In 2021, the one-year T-bill yielded only 0.1%. No rational investor parked money in an instrument paying 0.1% when equities were soaring and credit spreads were narrow. Liquidity fled toward risk. But by 2023, the same T-bill yielded 5.4%, the highest since 2007. Capital rushed back to short-term paper not because investors changed their minds, but because no one needed to reach for risk when short duration offered returns tens of times higher. The shift was quiet, but it siphoned liquidity away from sectors that had lived on ultra-low yields. High-yield credit, long-duration bonds, real estate, each drifted out of equilibrium as short-term yield became the new gravitational center. A third signal appeared on the yield curve itself. In July 2023, the spread between the 2-year and 10-year reached minus 108 basis points, the deepest inversion since 1981. When the market prices short-term risk higher than long-term risk, it implies a belief that the present turbulence is temporary. But when the present persists too long, that belief hollows out. An inverted curve is not a sign of collapse. It is a sign that the system no longer agrees on where time belongs. And when time loses its place, yields reorganize the structure. Around the same period, a quieter metric began rising: real yield. From minus 1.1% in 2021, the real 10-year climbed to 2.4%, by late 2023, the fastest jump since the Volcker era. Real yield captures the true weight of capital costs after inflation. When it rises 350 basis points in 2 years, the entire stock of legacy debt becomes outdated. Corporations that once borrowed around 2.3% in 2021 now face refinancing levels near 5.7%. Households that refinanced mortgages below 3% now face market rates above 8%, a 23-year high. When capital costs rise faster than productivity, which grew only about 1.4% per year throughout the 2010s, the system loses its ability to absorb the shock through growth. The weight spreads across every balance sheet. Household savings in the U.S., which stood at $2.1 trillion in 2021, fell below $500 billion by the end of 2023. Disposable income tightened while debt payments accelerated. On the corporate side, nearly $7.2 trillion of bonds are set to mature before 2026, much of it issued in the low-rate era. All of it must re-enter a market where yields are not negotiable. Duration becomes vulnerability not through crisis but through arithmetic. Governments feel the same pressure through a different mechanism. In 2023, interest payments consumed more than 15% of U.S. federal revenue. No political decision produced that ratio. It came from the math of rising yields colliding with fixed obligations. When interest absorbs a rising share of revenue, the budget shifts backward in time. Every dollar spent on the past is a dollar not spent on infrastructure, research, social programs, or defense. Cycles share this feature. When a budget pays more for yesterday than tomorrow, society moves in slow motion. Another quiet indicator surfaced in Treasury issuance. In 2023, net issuance reached $1.7 trillion, not a shocking figure, yet one echoing years when the system began drifting faster than growth itself. With real GDP expanding only 2.5% while debt expanded several times faster, yield had to correct the imbalance. It required no announcement, only time. Together, these developments brought the system to a temporary crest. Not the peak of yields, but the peak of confidence that yields would stop rising. In late 2021, investors believed 1.5% might represent a new normal for the 10-year. In 2006, they believed yields around 4.8% were stable because inflation looked contained. In 1994, they believed the Fed would not sustain tightening. These beliefs rarely shatter all at once. They erode, layer by layer, until yields force the system to reassess itself. From 2022 to 2023, this erosion unfolded slowly and coldly. No shock. No collapse, only the sense that time had grown heavier. Corporations delayed refinancing, hoping rates would fall. Investors shifted towards short maturities. Governments accepted higher borrowing costs to sustain operations. Households drew down savings to maintain living standards. No individual choice looked dramatic, yet together they formed the trajectory already recorded 3 times in modern history, the trajectory leading toward the yield wall an economy cannot avoid. Not because of failure, not because of panic, but because every cycle has a natural limit, the moment when time can no longer remain cheap. And that wall began forming on a day almost no one noticed. The day yields touched 5% and were treated as a ripple. The strange thing about pressure is that it rarely arrives like pressure. It arrives as small numbers that refuse to move in the direction they should. By early 2023, those numbers had begun aligning in a pattern that did not belong to a normal cycle. Real yields held above 2% even as inflation cooled. Household savings slid under $500 billion for the first time since the pandemic. Mortgage rates did not retreat after touching 8%. They stayed there, as if waiting for something. Corporate refinancing costs crept towards 6% and didn't blink. Nothing in those figures looked dramatic, but the shape they formed was too familiar to ignore. The market had seen shapes like this before, though never in quite the same configuration. In the early 1980s, real yields became a weight that industrial profits could not withstand. In 1994, a rapid tightening collided with debt structures that had no room for speed. In 2007, an ocean of mortgage resets met balance sheets that were already thinning. The dates change. The geometry doesn't. It is always 2 or 3 forces that begin far apart, then drift inward until they share the same narrow space. In this cycle, the first force was scheduled years earlier, the refinancing wave. Bonds minted in the zero-rate era were never designed for a world of 5% coupons. Yet nearly $7.2 trillion of such bonds were positioned to roll over between 2024 and 2026. The companies holding them were not fragile in a dramatic sense. They were fragile in a structural one. A firm that built its plans on 2.3% borrowing now faced a world priced at more than double that. The math did not shout. It simply waited. The second force moved through households. During the recovery, American consumers had acted like a stabilizer, holding the economy upright by spending from a reservoir that once measured $2.1 trillion. But by late 2023, that reservoir had mostly dried. At the same time, credit card interest passed 20%, auto loans hovered above 7%, and mortgage payments for new buyers climbed to their highest share of income in decades. A household can adjust to rising prices or rising rates. It cannot adjust to both without consequence. The data did not declare a breaking point. It only suggested that whatever would come next would not be absorbed easily. The third force was the quietest one: government borrowing. Interest payments crossing $659 billion did not represent panic. They represented drift. With issuance at $1.7 trillion in 2023 and the market increasingly sensitive to duration, the long end of the curve bore a weight that would not release. Auctions still cleared, but each required a slightly higher incentive than the one before. Yield is often treated like a number. But here, it acted more like a negotiation in which time was no longer the cheap side of the bargain. None of these forces were catastrophic on their own. Their danger came from convergence. Markets describe convergence as if it were sudden, but the truth is slower. It feels like three separate stories becoming one story without announcing the moment when the merging occurs. By mid-2024, the merging was difficult to deny. Real yields refused to soften. Corporate spreads drifted outward. Mortgage demand stayed flat even as housing inventory shrank. Household cash buffers continued falling. Government issuance widened the gap between where yields were and where they would have to go to clear future auctions. These were not crises. They were confirmations. Each new data point simply reinforced the last. In that sort of environment, the winners and losers sort themselves before anyone calls them by those names. The first group to tilt toward advantage were the holders of short-term paper. With T-bills paying above 5.5%, they stood in a part of the system immune to long-duration stress. Their decisions looked cautious, though they were more mathematical than psychological. When the safest asset in the world pays more than most risk assets did a decade earlier, choosing safety is no longer a retreat. It is a strategy. The second group were corporations whose balance sheets had not been built on the assumption of free money. Their interest burdens remained under 6% of EBITDA in 2023, allowing them to absorb higher refinancing costs without abandoning investment or employment. No announcements separated them from weaker firms. The distinction appeared in the numbers themselves, in how easily or how reluctantly they rolled over their debt. The third group were financial institutions cushioned by strong capital ratios. Banks with CET1 ratios above 13% could withstand unrealized losses on long-term securities without needing to liquidate. They did not look powerful, they looked stable. In a cycle shaped by rising yields, stability becomes a form of power because it allows time to work for you instead of against you. Most others faced the opposing side of the equation. Highly leveraged borrowers saw interest consume more than 20% of their earnings. Local governments encountered rising rollover costs and shrinking fiscal room. Households outside the fixed-rate mortgage fortress watched rents rise in tandem with financing costs. The yield cycle did not target them. It simply passed through them, and the pass-through was enough. What happened next did not resemble a crisis. It resembled a slowing. Construction cooled. Investment horizons shortened. Hiring plans softened around the edges. Auction demand for long maturities became more selective. These were small motions, but they carried the same pattern seen in past cycles. The system adjusting to a world where time had become expensive again. The adjustment created its own momentum. As yields stayed elevated, capital kept flowing into the short end. As capital flowed, long-duration assets lost some of the liquidity that once kept them buoyant. As liquidity thinned, refinancing costs held firm. And as those costs held firm, companies anticipated them earlier. cutting or delaying projects that would have been routine under lower rate conditions. Every decision fed the next one. Nothing dramatic happened, yet the direction was unmistakable. Looking back, the shift could be traced to a single point: the moment yields crossed a level the market did not think would return. October 19, 2023, was only remarkable in hindsight. The day the cost of borrowing ceased being a detail and became the defining characteristic of the cycle. Investors treated it as noise. Policymakers treated it as an outlier. But the system absorbed it, and once absorbed, it became permanent. The long-term patterns support this interpretation. After the 1979 inflection, it took until 1986 for yields to settle into a new equilibrium. After 1994, stability did not return until the early 2000s. After the 2006 inversion, the adjustment lasted through 2013. Every cycle required 5 to 7 years to rewrite the rules around time. It is not a function of policy. It is a function of duration itself, how long it takes for old debt to clear, new debt to price correctly, and the system to remember what borrowing actually costs. Today's cycle has already entered that phase. The repricing is not speculative, it is arithmetic. The shift is not sudden. It is cumulative. The consequences are not dramatic. They are structural. An economy built on the assumption of cheap time must eventually pay for the years it borrowed. That is not a crisis. It is a correction of memory. And once a system remembers something it tried to forget, it does not forget again quickly. This isn't a prediction. It's a mechanism.